Joining us today is Pat Dorsey, who is president of Nobel Captiva Investment Advisors, formerly of Morningstar, and the expert on Moats. Pat, it's a pleasure to have you here. As we get started, would you mind telling us a little bit about your background for those who are not as familiar, and you know how you got interested in the topic of moats, and then what your focus is today?
Sure. So I was director of equity research at Morningstar for about 10 years. I basically built the equity research team and process there, starting with about 10 analysts and building it to about 100 analysts when I left. And I kind of formed the intellectual framework, I guess you'd call it, that we use to evaluate companies. And a big part of that was and is a focus on competitive advantage or economic moats. And I became interested in the topic because this question of how some companies essentially defy economic gravity, manage to maintain high returns on capital despite competition. It's a fascinating one because economic theory suggests that all companies should just revert to the mean over time, right? Competition shows up, capital seeks excess profits, and you drive returns down. But both empirically and intuitively, we all know that's not the case. We can all name a dozen companies off the tops of our heads who have basically, defied the odds and maintained high returns on capital for decades at a stretch. But what frustrated me when I got into the topic is that most of the literature on competitive advantage is written from a strategy standpoint. Most of your readers, I'm sure, are familiar with Michael Porter's Five Forces model, which is very useful and a great starting point, but it's always from the perspective of a manager of a business. In other words, I manage a company or a unit of a company, and what can I do to make that piece of that company better? So it's all about kind of maximizing the assets that you have. But as investors, we have a different challenge. We're not stuck with a set of assets of which we need to maximize the value. We can choose from thousands of different sets of assets called companies, and so we need more, I would say, objective characteristics by which we can assess the quality of competitive advantage and then make some judgments about whether a company is likely to have high returns on capital in the future or not.
Let's maybe start from the beginning, and can you just define what you mean by moat?
Oh, sure. So I think when you think of an economic moat, and let's be clear that I stole the term from Warren Buffett. He's the one who coined it. If you're going to steal from the smartest guy around. A moat is structural and sustainable. I think those are the two key things for investors to think about. It's structural in that it's inherent to the business. The Tiffany brand is inherent to Tiffany. You can't imagine Tiffany without it. The switching costs of an Oracle database are inherent to the way databases are used in business. It's not something ephemeral. And you can contrast that with, a hot product or, a piece of hot technology that may come or go. And moats are also sustainable. They're things that are likely to be there in the future because, of course, as investors, we are, buying the future. We are, the investments we make today, how they turn out will depend largely on what happens 3 years from now, 2 years from now, 5 years from now, 10 years from now. And so we need to think about the sustainability of a competitive advantage. A company with a very hot product, a cool brand right now, may have very high returns on capital, but the sustainability is really in question. Whereas you can look at a railroad or a pipeline that would not have as high returns on capital as, say, a Abercrombie and Fitch or something, but it's very sustainable because you can predict the likelihood of that competitive advantage sticking around for many years, and that makes the investment process easier.
So it sounds like almost by definition then good management would not qualify as a moat. Is that right?
Not by itself. There's a wonderful quote from Buffett on this that let me look this one. I want to make sure I get it right because it's an awesome quote. mean, I'm sure many readers are familiar with the when management with a reputation for brilliance meets a company with a reputation for bad economics, it's the reputation of the company that remains intact. But there's another one that I think people are less familiar with, that good jockeys will do well on good horses, but not on broken down nags. And I think that's how investors should think about competitive advantage. The smartest manager in the world will not make an airline have the economics of a software company or an asset manager. It's physically impossible. And so, smart management is a wonderful thing to have. I'd rather have smart people running my companies than dumb people. But smart managers can build moats, they can enhance moats, they can destroy moats, but they are not moats themselves because management comes and goes. Corporate CEO turnover is higher today than it's ever been in the past. And getting back to this idea of buying the future, the economics of businesses change very slowly. Airlines don't suddenly overnight become wonderful businesses. Software companies don't overnight become bad businesses. Whereas managers can come and go. It's hard to make a confident bet in most cases, absent, high managerial ownership or a family position or something, that the guy who's in charge today will be there 5 years from now.
And what about people in general in an organization? A lot of companies say our biggest advantage are our people, but there are in fact a lot of businesses where that's the case, where the assets essentially walk out the door at night, walk in the morning. Can that be described as a moat, or do you feel like those people will find ways to extract the economics for themselves if they're in fact the asset of the company?
Now that's a fascinating question, and I think where you see the people extracting the rents is when they are unique. So this is why, for example, in the entertainment industry, usually it's the producer, the director, the actor who extracts the economic rents, not, say, the minority shareholder of a movie studio. I mean, that's typically the case because there's only one Tom Cruise, there's only one Ridley Scott, and so they will extract all the economic rents they can. But then if you look at, say, a Southwest, for example, which, I think arguably did create a corporate culture, which for a time gave it something of an edge over the competition. Those individuals did not extract excess economic rents from Southwest. And I think it's reasonable to say that that was a factor in Southwest's success. Was it a more important factor than Southwest being one of the first airlines to do point-to-point, fast turn, single model aircraft and all the other issues, other attributes people are familiar with? I think it's hard to say. The two kind of go together. And I would say that the corporate culture as an economic moat is very, very fuzzy, and unless you're prepared to get to know a company incredibly deeply, it can be hard to rely on, I think, as a competitive advantage.
Now, you mentioned that moats are structural, and it almost seems like they've been there forever, but how do moats actually come into being? How are they born at a company?
So, again, you can obviously build moats over time. I mean, not every company, we're not talking only about businesses that have been around for 50 years, like a Coca-Cola or a Procter & Gamble or something. And so I think it's important for the management of the company to be thinking about, how does it build competitive advantage? So one example might be, in addition to selling a product, you sell a service relationship along with the product. You look at the way, say, jet aircraft engines are sold today. Rolls-Royce PLC will often price its engines by hours used. And so, it's really, you're buying a service almost more than you are buying a big hunk of metal that you stick underneath an airframe. And that, of course, increases the switching costs tremendously. You're seeing a lot of manufacturers of sort of mission-critical equipment, whether it's airline parts or compressors that might be a key part of a chemical plant, start to realize that if they sell a service relationship along with just a product, they can really increase customer loyalty and thus increase the customer switching costs down the road. So that's a way in which you can as a company, move from just selling a thing, and things can be swapped out, to selling a relationship of service, which is a more stickier relationship. So that's the switching costs. That's what you would do. If your goal is to create a network effect, a good example here might be CoStar Group, which is the largest provider of. They're basically the FactSet or Bloomberg for commercial real estate. If you're Jones Lang LaSalle or C.B. Richard Ellis, you can't really live without CoStar's data. And what they did is they scaled very, very quickly because they realized that if they could stitch together a lot of very fragmented databases of commercial real estate information from different parts of the U.S. and different parts of the world, that would give them an advantage over the nascent competition, because they would benefit from a network effect where the more users they have, the more data they have, and so forth. And so for them, the key was scale. You wanted them to get big fast. That's not always what you want from a company, but given the moat they were trying to build, it made sense for them.
Now, in your book, The Five Rules for Successful Stock Investing, you also talk about moats, and there you say that companies generally build sustainable competitive advantage through either product differentiation, real or perceived, driving costs down, locking in customers with high switching costs, or locking out competitors through high barriers to entry. Can you tell us what type of moat you prefer over others, and which are generally more sustainable?
Um, I, I'm not sure there is one that's better than another. It's interesting. I get this question a lot, and I thought about it quite a bit. And I would say that there are weak and strong brands. There are weak and strong switching costs. There are cost advantages that are very, very durable, and some that are a little bit more ephemeral. So I'm not sure that I would regard one type of moat as stronger than another, with the possible exception of a network effect, which you see in financial exchanges, credit card processors like Visa and MasterCard, and businesses that tend to get more powerful the more users they have. Because there, the way a potential competitor would need to try to take away their economic profits is essentially by creating a similarly sized network. And that can be a very, very difficult thing to do. So I would say that generally speaking, if you can identify a true network effect, and it's a business that is reasonably priced and has a lot of room for reinvestment of capital at high marginal returns on capital, you've probably found a business that's going to have high returns on capital for some time to come. But that'd be really the only that'd be the exception more so than anything else.
It's interesting. Would you consider businesses that are, in a sense, natural monopolies, or essentially have this virtuous circle of volume and price, like a Walmart, a little bit related to the network concept, because the more customers they have, the cheaper they can sell things? Is that a good moat? Is that sustainable generally?
So it's interesting to characterize, Walmart as benefiting from a network effect, and I would say that, for Walmart, the simply buying more stuff isn't, what gives them the lower costs so much. It is efficiently moving that stuff around. If I had to think about Walmart and think of it just as pure volume versus efficient use of capital, in other words, a hyper-efficient distribution system, driving down, working capital as much as possible, I would say the latter is more important than sheer just we happen to be big. And so that's a real. I'm just thinking this through. Yeah, because Walmart. I mean, you think about it. You or I, we use Visa or MasterCard because lots of other people do. That's why it's accepted at lots of merchants, right?
Yep.
We trade securities on a particular exchange because we get a tight bid-ask spread and a deep level of volume, and we get that benefit because other people are there too. You or I, we don't care that lots of people shop at Walmart. We just want the lowest price. Now, Walmart happens to get that low price by being very, very efficient, But the simple fact that, you can frequently see there are people who undercut Walmart. They don't always on specific items. We just wind up going to Walmart because they have everything in one spot. So it's an interesting question, but I would say that generally speaking, I don't think of the network effect as always driving down costs because usually it's what you do with that buying power that tends to matter more than simply having the sheer buying power.
We also posed this question of moats to some of our members, and Josh Tarasoff of Greenlee Lane Capital wrote in and said his least favorite moat is customer captivity because it tends to be kind of static and it doesn't really imply progress for a business, and also it may actually make it harder to win new customers if they know uh, they're going to become captive for a long time. It also seems to me like if that's your moat, you may not have a very happy customer base. You just may kind of have them by the guts and they can't get away. But the minute they see an alternative, they might jump at it because they're not very happy. They're just there because they're captive.
I don't know about that. It's true that you see very strong switching costs. You often see that in more mature areas. So you can think of a Jack Henry, which does back office processing for banks, usually smaller ones. The customer retention rate is like in the high 90s. It's insane. But of course, the number of banks isn't growing a whole lot year to year. So they're not losing anybody, but they're not gaining anybody either. Oracle is a pretty similar business. Oracle doesn't lose much market share, but databases are a very mature business. Doesn't grow a lot from year to year. Oracle's mainly grows the core database business by kind of raising price a little bit from year to year. So I would say that there is probably a decent correlation between the strength of a switching cost and the maturity of a market. I think that's a reasonable thing to say. But just because a market is mature doesn't mean that the business isn't a quality business and can't be mispriced if it's being valued as a declining business, for example. You look at the elevator companies, whether it's Otis, which is part of United Technologies, or Schindler, which is a German business, or Kone, which is a Finnish. And they've all, despite the very high switching costs of an elevator or an escalator, once it's in the building, you typically don't rip it out and put another one in. They've experienced pretty reasonable levels of growth as you've seen the urbanization of China and other areas of the world. Now it's more cyclical, of course, but so I don't know. I guess I wouldn't say that it's my least favorite kind of mode. I think it does. You do tend to see it more often in mature businesses. So you have to be a little bit more careful with what you pay for those, obviously. But I don't know. Customer, being able to raise prices every year on your customers is a pretty good thing, I think.
Yeah, I think maybe there's
the key there is to not abuse it. So
right.
I'll give you an example. When I met with so if you want to think about a business that really does have some of its customers but short hairs, as we say, CoStar would be a good example. C.D. Richard Ellis, Jones Lang, big commercial real estate brokers literally can't live without this data. Morningstar hosted the CEO of CoStar Group at the conference a year or two ago, and I remember asking him, somebody asked him, so how he thinks about pricing, because he has not infinite, but he has a lot of pricing leverage over these customers, and he'd obviously thought about it very carefully. He said, "Listen, we are interested in long-run profit maximization, not in angering our customer base." And I think that's how you have to think about it. If you're a business with a product that is critical to a customer's business and where you have enormous pricing power, if you really do exert that in a very, very strong and aggressive fashion, you will invite competition, kind of as Josh was implying, that the customer's going to want to go somewhere else. But if you kind of balance the value you're delivering versus the cost to the client, and you don't stick with sort of inflation or inflation plus pricing, you can keep that going for quite a while without really incenting the customer to go somewhere else.
Yeah, that's a great point. I think, what was interesting for me is when you talk about a business that has its moat through network effects, those network effects directly make the customer experience better.
Exactly.
There's just more value to each customer from the network. With something like customer captivity, it seems to have the connotation that, well, if the customer could decide every day, just make a blank slate decision where it would want to take its business and there would be no switching cost, it might actually go to a competitor because they might have a better product or a better price. So it's almost like even if a competing offering is better, the customer captivity makes a customer stay there, and there's kind of that gap. So that's the
Exactly. I mean,
cost. Yeah.
exactly. You could call up a bunch of the smartest engineers you know and create the MOI database, okay? And maybe it's 15% faster and 20% cheaper than anything Oracle has on the market. And you walk over to Procter and Gamble or Amazon and say, "I think you should buy my new MOI database. It's really cool."
Yeah.
You know, they're going to have to invest tens of millions of dollars and how many hundreds of thousands of man hours to rip out their current one and install yours, right? Now, if you had something that was 80% faster and 80% cheaper, they might do it, right? I mean, there is at some point where you do switch, but
Yep.
it's
Absolutely.
typically a pretty high one.
Now, let's talk maybe a little bit about sustainability.
Hmm.
And, ideally you have a moat and it's sustainable for a very, very long time. And Warren Buffett has been great at finding businesses like that and investing for the long term. Um, do you think that consumer-facing businesses that essentially build up mind share in the consumer, like a Coca-Cola, perhaps have the most sustainable moats, or do you think business-to-business companies can have similarly sustainable moats?
Ooh, that's interesting. I think what matters less is who your end customer is, a business or a consumer, and I think it's more about the speed of evolution of the product set.
Hmm.
Soda doesn't evolve. Soda doesn't change a lot from year to year, right? Software does. So, if I had to make a bet today as to who is more likely to have high returns on capital 10 years from now, I'm going to bet on a soda company before a software company, simply because there's less stuff that's likely to change over the next decade.
Yep.
But that's what's important, right? It's more about what is the product and not about what is who is the end customer. And the thing with brands you have to remember is brands take constant care and feeding, right? I mean, brands don't just run themselves. Management teams can try to destroy brands. I mean, do you remember Schlitz? I mean, Schlitz was number one, number two in market share for in the U.S. beer market from the mid 50s to the early 70s or thereabouts. Number one or two, each year they kind of trade off. And basically, what they do? They change the recipe. Well, that's smart. You got the number one beer, you change the recipe, right? But you can't tell what stupid management teams are going to do. Remember New Coke?
Yep.
And so again, that's one where my point is that these things don't run on autopilot. They require sort of constant care and feeding. And you can look at some consumer product categories. I mean, would you have imagined 10 years ago that there would be private label beer? Kirkland's. Costco sells private label beer, and it's not bad. It's not great, but it's not bad. It's not bad. But seriously, and so that's an area where I think it's hard to say that it's all about whether it's consumer or business, because even beer. Really, if you'd asked me 10 years ago, product categories would be least susceptible to private label competition, I probably would have put alcoholic beverages and confections as like number one and number two, you know. And okay, I've been wrong on one of them. Now I'm just waiting for Kirkland brand chocolate. You know, that's probably not going to happen. But so anyway, I mean, that's kind of a long answer to a very interesting question. That I think it's more about kind of the speed with which a product category changes than really anything else.
Yeah, I think where I was coming from was maybe to look at how rationally the customer makes his or her decision, and I feel like in the business to business market, they're pretty rational. They're going to weigh the costs
Yeah,
and so forth.
you're right. There is less of an emotional
Hmm.
standpoint, right? But there are sometimes emotional and reputational factors. Remember
Yep.
the old quote, "You don't get fired for buying IBM."
Yep. Absolutely.
And there's some truth to that, So reputation and brands can matter in the business to business market as well. But the key thing to look about, and look at, I think, and this gets back to your initial point about mind share, which I conveniently ignored, is does the brand change consumer behavior?
Hmm.
Does it actually make the customer act differently? And it can do that in one of two ways. It can either increase the customer's willingness to pay, right? You pay more for Coke than you do for President's Choice Cola. You pay more for Hershey's than you do for, lower end chocolates.
Kirkland.
Whatever. Kirkland chocolate, yeah, the famous Kirkland chocolate, exactly. Um, or does it reduce search costs? In other words, you become familiar with the product. You don't want to compare prices all the time on a stick of gum. So you just buy Wrigley, right? You buy Wrigley because you know it's what you want, and it's a 50-cent pack of gum. I'm not going to sit here comparing prices. You've reduced my search cost. But if the brand doesn't change my behavior in one of those two ways, I would argue it's not worth a dime. I mean, think of the Sony brand, right? The Sony brand is incredibly well known. It's still in like the top 20 most valuable brands in the world, according to the, big annual Interbrand survey. But would any of us, any reader reading this interview now, pay 20% more for a Sony DVD player relative to one from Philips or Panasonic? I doubt it.
So
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 there you have a company with mind share. I think Sony has mind share. We've all heard of it, right? We all
yep.
know Sony very well, but it doesn't change our behavior. So what good is the brand?
So if we flip that around and let's take Apple, which is doing phenomenally well right now, but I would assume you would say the brand is not going to sustain its advantage. It's something else. And
Exactly. It's
is
not the brand. It's the network effect.
yep.
Pure and simple. Because and if you go back and look, I mean, I get this question all the time. People think that Apple buyers are all just about the brand and looking cool and having little white threads dangling out of their ears. Like this makes you a cool person, I guess, which is manifestly not the case. It's the network effect. The iPhone, it does have a wonderful user interface and lots of good features, but it also has hundreds of, tens of thousands of apps. Why does it have tens of thousands of apps? Because developers want to write for the platform with the most users, and users want to buy the phone with the most apps. It's a beautiful network effect. And we can validate this by going back and looking at the initial iPod sales. Okay, when the iPod first came on the market, you remember the Zune was on the market too at the same time? For the first, I want to say year, maybe 2 years of the iPod's existence, that was before iTunes, okay? And the iPod sold okay. It sold reasonably well. It wasn't a huge hit. Then iTunes came along, and suddenly you could buy songs by the drink, but only if you had an iPod. Bam! Hockey stick growth. And then if you're a music publisher, why do you want to be on iTunes? Because you got all those people with iPods out there. Why do you want as a user to buy an iPod? Because it's the only thing I can use to buy a song one by one, legally. This is before they shut down Napster. So I think for me it's a network effect for Apple. And when I look at Apple, when I think about Apple as a business, and it's in the wide mode portfolio that I have, I'm far less concerned about nice advertising or cool design than I am about anything that increases the switching cost, anything that increases the difficulty I would have of switching from my iPhone to an Android. Anything they can do to make that path dependence stronger, that now once I've got an iPhone, I want the next generation. That's what strengthens their moat more than anything else.
Interesting. Could you tell us a few examples of companies that you consider have strong, durable moats? Perhaps some names that are not as well known as maybe some of the Berkshire holdings.
Oh yeah, sure. So that'd be some good examples. I'm trying to think of ones that are kind of less well known. So, sorry, I always want to try to go off the beaten path when I can. It's not the easiest thing because what's cheap now and what's been cheap for a while has been the big stuff. So that's what I've been focusing on. So do these need to be well priced right now, or just have good moats?
Oh, let's just have good moats for now, and
Okay,
then
good, because yeah, the smaller stuff tends to get more expensive, you know. So CoStar, which I mentioned this earlier, so I'll just kind of talk about it a little bit. Basically, they have data on properties and tenants for commercial real estate users. So you think commercial real estate is much more differentiated than residential real estate because you might have whether a building is facing a certain side of a street or it's a Class A property, Class B property. It's each office building is very unique, and so having a very rich set of data really gives them an enormous advantage. They've got about 90% client retention right now, I want to say. Yeah, about 90%, and then usually kind of inflationary cost increases. To replicate this database, you would basically need to spend everything that CoStar has in acquiring over the past 8 years now. And even then you would have a hard time doing it because typically what they've done is bought the best best regional commercial property databases, and so there isn't another one out there. So you'd need to replicate this from scratch, which would be very difficult. So that's that kind of a very interesting little business that I don't think people know as well. It's not cheap right now by any stretch, but if we can get another housing crisis, it'll get cheap again. What would be another really interesting one? Is Express Scripts too familiar to people, do you think?
probably qualifies as not
Yeah,
familiar.
I'm just saying. I don't know if that's off the beaten path enough. We could do. How about MSCI? This is we're in the financial business. People have heard of this, right?
Yep.
So MSCI spun off from Morgan Stanley a while back, and basically they have two business. They own the MSCI indexes, which is just a pure index licensing business model that's just gorgeous. Because every time a Brazil ETF launches, they need to license MSCI's in the MSCI Brazil index, and that generates them a fairly small but essentially no cost revenue stream, and that's just an unbelievably beautiful business. And then they also have a business called Barra that is basically kind of the gold standard for risk management software for asset managers. An asset manager will typically often ask, what's your borrower risk, or show me your borrower printout. And even if they don't believe in borrower, even if they don't think borrower's, philosophy of assessing risk based on volatility and beta and whatnot is worth a hoot, it doesn't matter because the consultant's going to want to see it. So you kind of have to have it. And so they have about 85% renewal rates, which is pretty good. So that's a wonderful little wide moat business. It's only about $4 billion market cap, not too big. But just a beautiful little business.
So yeah, well,
anyways,
maybe
I mean,
maybe while you think of something else, or we can also discuss bigger companies. I was just going to throw out the controversial one out there and see if you still think that Moody's and S&P ratings have a moat.
Ooh, that's an interesting one. Well, their returns on capital and margins certainly suggest that they do. I mean, you look at them. Really, look, you don't have to love to like them. But last quarter, Moody's did. Operating margins are still running in the high 30s. then it's down from the mid 50s, but it's not chopped liver by any stretch. Yeah, I wouldn't mind having those kind of margins. Um, so, I would say they do. At the end of the day, the nature of the bond rating market lends itself to a natural oligopoly. And you can look. Fitch has not gained a lot of market share. Sean Egan at Egan Jones has had some wonderful calls. He's kind of a controversial guy, but they've done good work. They really haven't gained much market share, at all. So it's just a business where I don't think it's particularly cheap right now, and I think it's pretty hard to figure out, what the growth rate looks like going forward. I think the hard thing with Moody's is not figuring out do they still have good margins 5 years from now, but figuring out how big is the business. That's the hard thing.
Yeah.
But in terms of, is it sort of a natural oligopoly and will it retain its high returns on capital? I don't think there's much question of that. I think the much harder thing is figuring out what the size of that business is, and then how you price that cash flow stream.
Maybe we can.
And I can't do that, which is why I don't own it.
Sure. Let's maybe move on to some larger caps, and I'm curious whether you think American Express or Visa/MasterCard have a wider moat. And basically what I'm alluding to is kind of the closed loop model of American Express versus the more open model of Visa and MasterCard.
Yeah, so, but well, it's closed versus open, but they're also different businesses. Because Amex is lending money, whereas Visa and MasterCard are not.
Yep, absolutely.
Yes, so I think it's an important distinction to make, I think, because you saw that, in the run-up to the credit crunch, Amex had some serious underwriting mistakes. They basically, some of their underwriting metrics were based on, home prices, and they did a lot of marketing in the Sand States, and that came back to bite them. The nice thing about credit cards, unlike mortgages, is that the problem loans run off pretty quickly. They reprice pretty fast. So it didn't kill them because it was a well-capitalized business. But you saw where that bad suboptimal maybe underwriting really did damage them. Whereas again, Visa and MasterCard, they're just toll bridges. They're not lending money to anybody. So it's a much less risky business in that sense. So I think that the scope for management to damage those businesses is a lot lower than say Amex. Amex has learned from its mistakes, certainly. They've gotten better at the underwriting since the Sand State debacle. But I think that the hard thing with MasterCard and Visa right now is that you are seeing some chance of technological disruption with emergence of PayPal and other mobile platforms. How likely it is to really hurt things is hard to say, but it's certainly you have more risk of disruption than you would with a Coca-Cola or a Budweiser or something like that. But the other difficulty that they're facing is that you're seeing a little bit of a price war emerging, where they're kind of engaging in these kind of rewards programs, and it's almost like who can give the more rewards out, and that's kind of how consumers are starting to choose between what card they use, and that's probably long run not a great thing for the business. I don't think it's I'm not losing sleep over it, but I don't think it's long run not a great thing.
That's interesting. What do you think of major pharma? And sorry to jump around, but we don't have a ton of time. Those businesses have high returns, have always had high returns, but it seems like if you have a blockbuster drug, it's all about when the patent expires. Do you feel like those really big pharma companies have sustainable competitive advantage?
Yeah, and again, it's almost a little bit like Moody's. The margins are there. It's the growth that's hard. And I think big pharma was very slow to realize that the business model had changed, right? 2 decades ago, even a decade ago, it was all about bringing out big blockbuster drugs that treated chronic conditions. High blood pressure being the biggest one with the statins that were out there, depression with Lexapro and drugs like that. And these are drugs where it's a chronic condition, and so you need to get it out to lots and lots of patients, lots and lots of potential patients, at a relatively low marketing cost. So what do you need? You need an army of salespeople, right? Um, and so that was the business model 15, 20 years ago. But then, as we got what you would call good enough products for treating high blood pressure, for treating cholesterol, for treating depression, and those went generic, the opportunity to improve upon the prior drug is very small. So you've seen this business model shift to higher priced drugs, especially in oncology, to that they're higher priced drugs, but you need to market to a much more specialized set of doctors. And so you don't need tons and tons of salespeople. You need a smaller number of very highly trained salespeople. And so that business model shift took some time, and it was only really, I think, a couple of years ago, after one of the two big pharma mergers. It wasn't Pfizer. I can't remember which one, that you started to see sales forces really come down, big cuts in the sales forces. And I think that was a big, an important moment, because it meant that big pharma was sort of realizing that the world had changed a bit. But I guess I think about big pharma almost as distribution platforms more than anything else. I mean, part of their value is to some extent these giant R&D labs, but so much of the innovation is happening in large molecule drugs and in biologics right now. And then you get the big pharma companies buying the more innovative, smaller businesses. But the value that a big pharma company generates is it having this massive distribution platform. Established relationships, trusted relationships with thousands, tens of thousands of practitioners around the globe. And that's something that would be very, very hard to replicate, much more so than having a new and innovative molecule.
And maybe to finish it up, I have probably what's too broad a question, but I'll try it anyway. Buffett talks about he wants Berkshire subsidiaries to essentially just think about how they can widen the moat every day. And so what would be your advice to companies and CEOs, what they can do to widen the moat of their companies?
Okay, yes, that is broad. It's my next book if I ever get around to writing it. I think it really depends a lot on what kind of moat you're trying to build. And I think that so if I had to think about a few themes, one would be that you tend to see, commoditization is correlated with management impact. If you're the manager of a retailer, of an insurance company, of a commodity company, a miner, for example, a bank, you can have a huge impact on whether your business is great or good, in the Jim Collins words. If you're managing a business that already has a wide moat, you're more of a caretaker. Your job is to not screw up. Your job is not to roll out new Coke, right? Your job is to keep the business going the way it is. But waking up every morning, and this goes back to the theme about sort of what have you done to widen the moat. Whatever your moat is, that should constantly inform every business decision that you make. Back to you, we began this conversation with Walmart. Think about 5-7 years ago when Walmart started to try and compete with Target in fashion. Remember that? They started rolling out a product.
Yep.
Remember that?
Yep.
And did it work? Not really. Because that's not what you don't go to Walmart for hot clothes. You go there for cheap prices. They got off strategy. They forgot the reason why their customers shop there. And then they kind of retooled, and that laser focus on low prices is what matters for them. Think about LVMH and their focus on scarcity and exclusivity. They'll actually destroy unsold bags. They'll take a $2,000 bag and just shred it to keep that scarcity out there. Or my favorite example, because it's one that I got wrong, think about Amazon's laser focus on the customer experience. That drives everything they do, is how can they make the customer experience better. And that really is what's created their moat more than anything else, because Jeff Bezos realized very early on that online shopping is different than offline shopping, right? Offline, there's no trust involved. If I walk into a store, I hand somebody cash, they hand me a product, our relationship is finished. There's no trust. But online, I got to trust you send me the right product. I got to trust you don't steal my credit card. I got to trust you send it to me in the time that you say you're going to send it to me. There's a lot of trust there. So a brand matters more online. And I think Bezos figured that out very early on. And that really is everything that Amazon does is about making the customer experience better. And that's why people use it. I mean, I've probably given 50 talks on moats around the world. And I always ask the audience how many people have bought something off Amazon without checking the price anywhere else. Usually over 3/4 of the hands go up, which is an amazing statement when you think about the ease of checking the price somewhere else.
Yeah, it's true.
So,
That's
anyway,
what I do.
So that's I mean, yeah. So that focus matters. You know, not diversifying. I think you frequently see CEOs have a very good but slower growing business that has a great moat to very high returns on capital, and then they say, "My gosh, we still got to grow," and so then they take the capital and they basically set it on fire by investing it in a business where they have no competitive advantage. Like Cintas, when they moved from uniform rental to fire safety and document management, right? Stupid. Cisco moving into set-top boxes and buying the Flip, stupid. Garmin, remember the GPS company, trying to expand into handsets, competing with Nokia and Samsung, stupid. In all three of those cases, the company would have been far better off just sticking with what it did best and then taking whatever capital it couldn't reinvest in the core business and returning it to shareholders. But of course, because CEOs of bigger companies get paid more than CEOs of smaller companies, that institutional imperative for growth is always there and always a risk as a minority shareholder.
Yep.
Sorry, you got me off on bad management. It's never a good idea.
We'll save that for another conversation. But Pat, is there anything that we haven't touched on that you like to mention in your talks and maybe highlight here as we finish up?
I think maybe the one thing I would say is when people are thinking about sort of how do I value a moat, right? Like when is a moat really valuable? When is it less valuable? I think the key thing to think about is the length of the runway, right? What are the reinvestment opportunities that a company has? So a Visa or a MasterCard or a Chicago Mercantile Exchange or a C.H. Robinson or an Expeditors. These are all companies which have either are in growing markets or which are in mature markets with very small market shares. And so there's a lot of opportunity to reinvest capital at a high incremental rate of return. And so that moat, that ability to reinvest for 10 years before somebody really winds up eating your competitive lunch is incredibly valuable. Contrast that with a Microsoft or a McCormick, both of which have very strong moats. But you know what? The volume of Windows ain't going up much year to year. The volume of spice consumption in the U.S. is not increasing much year to year. Okay, so McCormick's moat doesn't really add a lot of economic value. It adds stability, it adds predictability, but it's not worth paying a ton of money for because it doesn't allow the company to grow all that much. Whereas the moat for a business that has those reinvestment opportunities is very, very valuable. So because that's often how I think about sort of the when do I want to pay up for a moat question, is whether that moat actually is going to allow the company to reinvest a lot of capital at a high rate of return, or does it just sort of add to stability and predictability?
Do a few companies come to mind that fit that bill for you?
Which bill?
The bill of having a wide moat and ability to reinvest a lot of capital.
Having a runway, sure. So it's a small group. I think Fastenal still has that characteristic. They still got single-digit market share. I think maybe low double-digit, but they've got certainly plenty of runway ahead of them. Both Expeditors and C.H. Robinson, which are in different parts of the freight forwarding market, have plenty of, I think, runway ahead of them right now. Would be another good example. I think Visa and Microsoft, Visa and Mastercard have that attribute. Although their market shares are unlikely to grow, the evolution of a payment from paper or check to plastic is, not as far advanced as you might think, and there's a lot. So they have a kind of a nice secular tailwind behind them, even if they don't, wind up gaining much market share from one another. So those would be a few examples. I'm sure there's plenty of other ones, but those would be kind of the ones that come immediately to mind.
Pat, well, thank you so much for your time and your insights. I just want to draw everyone's attention also to your wonderful books that anyone can find by going to Amazon and searching under Pat Dorsey, and no price checks required there. um, but thank you very much. We really learned a lot and appreciate your time.